In 1973, a single phone call from Washington to Riyadh changed the fate of world money. Oil would be sold only in dollars. It sounded like a trade agreement. In fact, it was a new empire forming, invisible, liquid, and global. For the first time in history, energy itself became a monetary weapon. The world didn't vote for it, the world adapted. The United States printed paper, the rest of the planet pumped oil, and the balance held. But behind that elegant symmetry hid a dangerous dependency. If the dollar fell, oil would fall with it. And if oil broke free, the dollar's crown would crack. It began as a pact of necessity. America needed energy stability after the chaos of the 1970s. Saudi Arabia needed protection, weapons, and access to global finance. The result was not just an alliance, it was a system. Every barrel of oil priced in dollars created new demand for U.S. currency. Every transaction reinforced its supremacy. The dollar became more than money. It became oxygen. Few realized how fragile that oxygen was. To keep the dollar strong, oil had to remain expensive, but not too expensive. Wars had to be fought, but not won. Crises had to erupt, but never resolve. Every movement in the Persian Gulf was a financial pulse, every sanction a coded signal. What most saw as geopolitics was in fact accounting. The flow of petrodollars recycled through Wall Street, funding U.S. deficits, stabilizing Treasury markets, and shaping global inequality. Nations didn't just buy oil, they bought into the dollar's mythology. To trade energy, they needed currency. To get currency, they needed to lend back to the U.S. And now, half a century later, that hidden equation is breaking down. Oil no longer answers to one master. New clearing systems, new alliances, new digital ledgers, each one erodes the monopoly born in 1973. The petrodollar is aging. Its last war has already begun. Some call it de-dollarization, others a return to balance. But behind both lies a single question. What happens when the world's most powerful promise, payable in dollars, no longer means safety? To understand how the petrodollar was born, we must return to the early 1970s, a decade that began with abundance and ended with exhaustion. The United States had just emerged from the post-war boom. The dollar was still officially tied to gold, oil was cheap, and global trade revolved around American credit. Yet beneath the surface, the numbers no longer balanced. Since the 1950s, Washington had financed its dominance through spending on the military, on reconstruction, on consumer prosperity. Dollars flooded abroad, funding allies, bases, and imports. For a while, that flood looked like strength. In truth, it was dilution. There were more dollars outside the U.S. than gold inside Fort Knox. The promise of convertibility, $35 for an ounce, had become mathematical fiction. By 1971, the illusion broke. On August 15th, Richard Nixon closed the gold window. The dollar ceased to be backed by metal. It was now backed by confidence. The world woke up to a new paradox, a currency without anchor ruling a system built on trust. And that trust had to be manufactured, fast. Oil became the chosen tool. Energy was universal, essential, and priced in barrels that could absorb inflation. If oil were tied to the dollar, demand for dollars would never end. This was the logic behind the petrodollar, a self-sustaining loop where energy demand secured monetary dominance. But loops require symmetry. The United States needed someone to guarantee that oil would, in fact, be priced only in its currency. That partner was Saudi Arabia. After the Yom Kippur War in 1973, the U.S. faced both an energy crisis and a geopolitical dilemma. The Arab states had discovered the power of embargoes. Prices quadrupled within months. For the first time, Western economies felt the weight of oil as leverage. Amid the chaos, American officials began a series of discreet meetings, the kind that never make front pages but change everything. In 1974, Treasury Secretary William Simon and his deputy, Jerry Parsky, traveled to Jeddah under strict secrecy. Their goal was not diplomacy, but design. they offered the House of Saud a proposition: security in exchange for monetary loyalty. The U.S. would protect the kingdom, supply arms, and defend its sovereignty. In return, every barrel of Saudi oil would be sold exclusively in dollars, and the surplus profits, the petrodollars, would be reinvested into U.S. government bonds. It was a brilliant mechanism. The Saudis gained a guaranteed buyer and protector. America gained infinite external demand for its currency and debt. Each transaction, each tanker, became an invisible subsidy for the dollar. The oil market stabilized, inflation eased, Wall Street was flooded with recycled Saudi capital. But this stability was not natural, it was engineered. Other nations followed the Saudi lead. Soon OPEC's oil trade was dollarized by default. European and Asian importers had to hold dollars to buy energy, which meant buying U.S. debt to earn them. The global monetary system reorganized itself around oil flows rather than gold reserves. The world had entered the era of energy money. The irony is that this system was never formalized in the treaty. No document, no signature, only mutual dependence. A handshake turned into an empire. The petrodollar was not law, it was habit. And like all habits, it worked only as long as everyone believed there was no alternative. Half a century later, that belief is eroding. Energy no longer flows through one corridor, nor is finance limited to one language. What began as a clever monetary pact is now the backbone of a fragile world order. And every fluctuation in oil prices still echoes the logic born in that secret room in Jeddah. By the late 1970s, the petrodollar system was working too well, and that was precisely the problem. The U.S. could issue debt without restraint, knowing that foreign oil importers would keep buying dollars to pay for energy. The more the world consumed, the more America could print. Debt became the invisible engine of growth, but engines overheat. The numbers began to defy logic. Between 1973 and 1981, the price of oil jumped from $3 a barrel to over $35. Inflation in the United States reached double digits. Europe and Japan were forced to pay more not only for energy, but for the dollars needed to buy it. The system fed on itself. Higher prices meant more dollar demand, which strengthened the currency, which in turn deepened global dependence on it. The mechanism was elegant, but unstable. The U.S. trade deficit widened, manufacturing eroded, finance replaced production as the new national export. Wall Street became the refinery for petrodollars. Every surplus earned by OPEC was recycled into American assets. But a refinery built on trust is vulnerable to panic. Then came 1979. The Iranian Revolution ignited a second oil shock. Supply collapsed, prices spiked, and suddenly the flow of petrodollars surged beyond control. Trillions in new reserves flooded into Western banks, seeking yield. The Federal Reserve under Paul Volcker responded with an unprecedented move, interest rates above 20%. It was a surgical strike: crush inflation, restore dollar credibility, re-anchor faith. It worked, but at a global cost. Developing nations that had borrowed in dollars were crushed under debt. Latin America entered a decade of economic ruin. The dollar's strength became their weakness. Oil exporters, too, suffered from the volatility of their own weapon. The petrodollar system had created a hierarchy of pain: stability for the issuer, instability for the users. Some economists began to see the pattern. The dollar was no longer just the medium of trade, it was the instrument of control. Each crisis reinforced its dominance. When debtors fell, they were forced to borrow again, in dollars. When oil revenues collapsed, producers had to sell more oil, in dollars. The cycle had no moral, only mechanics. And yet the illusion of balance persisted. Nations complained, but continued to comply. The system's brilliance lay in its asymmetry. The U.S. exported inflation and imported security. Everyone else exported goods and imported risk. Even allies understood. To challenge the dollar was to step outside the safety net of global liquidity. But every system, no matter how vast, has a saturation point. By the 1990s, oil consumption kept rising, but trust in the dollar's permanence began to erode. Regional blocs explored other pricing models. The euro was born as a quiet alternative. China emerged as both a manufacturing power and an energy consumer large enough to shift gravity. The monopoly began to tremble. Not through rebellion, but through evolution. The moment of truth arrived much later, disguised as crisis. In 2008, when the financial markets imploded, oil prices collapsed overnight. For a brief moment, demand for dollars spiked. But this time the money flowed not into trade, but into rescue. The Federal Reserve printed more than the world had ever seen, and yet inflation stayed hidden. The petrodollar had turned into a paradox. It survived only by consuming itself. Some historians call it the silent default. The system no longer served the world, it served its own preservation. The dollar became too important to fail and therefore too fragile to trust. To understand how the petrodollar held the world for half a century, we have to look not at politics, but at plumbing, the hidden circuits of money flow. On the surface, it looked simple. Countries bought oil in dollars. But underneath, every transaction triggered a chain reaction that shaped global finance. Here's how it worked. An oil importer, say Japan, purchased crude from Saudi Arabia. Payment was made in US dollars, transferred through American correspondent banks. Those dollars didn't stay in Riyadh. Almost immediately, they returned to New York or London, deposited in major banks, or invested in U.S. Treasury bonds. The cycle was perfect. Dollars left the U.S. to pay for oil and then circled back as capital inflows. What looked like trade was in fact a loop of debt and reinvestment. This recycling wasn't a side effect. It was the system's core. The U.S. could run constant trade deficits without losing power because its deficits were the world's reserves. The rest of the planet saved in the very currency America spent. It was a monetary mirror. One nation's debt became everyone else's security. The mechanism created what economists call exorbitant privilege. Washington could finance wars, bailouts, and social programs with money printed at near zero cost, while others paid real value to obtain it. Dollars were not just a medium, they were leverage. Every central bank needed them to stabilize exchange rates, build reserves, and pay for energy imports. Oil exporters, flush with petrodollars, deposited their earnings into Western banks. Those banks then lent the money to emerging economies, especially in Latin America and Asia. It seemed efficient. Global liquidity recycled through financial centers, funding growth. But when U.S. interest rates spiked or the dollar strengthened, the flow reversed, leaving debtor nations bankrupt. In effect, the petrodollar system outsourced volatility. The U.S. exported inflation in the 1970s, exported debt in the 1980s, and exported crises in the 1990s. Each wave consolidated its position. When others defaulted, investors fled to safety, and safety meant U.S. assets. The stronger the storm, the deeper the world's dependence. Even central banks became instruments of this mechanism. The Bank of England, the Bundesbank, the Bank of Japan, all had to manage reserves in dollars, not gold. Monetary sovereignty became conditional. Countries could print their own money, but not their own oil payments. By the 2000s, digital trading systems and the SWIFT network turned this into pure infrastructure. Every oil contract, every settlement, every hedge passed through the dollar's circuits. The U.S. no longer needed to enforce its dominance through treaties. The code did it automatically. And yet, hidden inside this perfection was its flaw. The system required absolute trust in two things: that oil would keep flowing and that the dollar would keep buying. When either faltered, through war, sanctions, or overproduction, the feedback loop trembled. The dollar's strength depended on the very volatility it created. Some economists call it controlled instability. Every crisis was both a threat and a renewal. When the Gulf burned, capital fled to Treasury bonds. When markets panicked, the Federal Reserve printed liquidity, and the world called it safety. The petrodollar system learned to feed on uncertainty, but a system that thrives on tension must one day consume itself. Because sooner or later, energy finds new routes and code finds new ledgers. The petrodollar's true weakness was never economic, it was technological. By the dawn of the 21st century, the petrodollar had reshaped the entire global order, quietly, methodically, and with a precision no empire had ever achieved through force. But every system of control creates its own residue. The first cracks appeared where few expected, in the very nations that had depended on it most. For oil exporters, prosperity turned into paralysis. Easy dollars flooded local economies, inflating currencies and hollowing out industries. The term Dutch disease was coined to describe it: wealth that kills productivity. Saudi Arabia, Nigeria, Venezuela all became rich in revenue, but poor in diversification. The dollar made them powerful, but also dependent. Their budgets rose and fell with every move of the Federal Reserve's interest rate. For developing nations, the consequences were harsher. In the 1980s, as U.S. rates soared, countries from Mexico to Argentina saw their debts triple overnight. Loans denominated in dollars became unpayable in local currencies. The IMF stepped in, but the medicine was austerity, privatization, spending cuts, and structural reforms that tethered those economies even tighter to global capital. The petrodollar had become the silent architect of inequality. Meanwhile, the United States enjoyed what no empire before could: consumption without consequence. Deficits no longer meant weakness, they meant demand. The Treasury issued bonds, the world bought them, and the cycle continued. American households borrowed cheaply, corporations expanded abroad, and the military patrolled the very trade routes that sustained the loop. Stability had been outsourced. Security had been monetized. But the hidden cost was political entropy. The Global South began to associate dollar stability with economic subordination. Europe, even while prospering, quietly sought autonomy, first through the ECU, then the euro. In 1999, for the first time in half a century, there was an alternative reserve currency. The petrodollar monopoly wasn't broken, but it was no longer absolute. Then came the wars: Iraq, Libya, interventions framed as security but underpinned by energy. Some analysts noted an uncomfortable pattern. Both Saddam Hussein and Muammar Gaddafi had tried to sell oil outside the dollar system. Their regimes ended swiftly. Coincidence? Perhaps. But the signal was clear. Currency loyalty was still a matter of survival. At home, the mechanism that had once made the U.S. omnipotent began to corrode its foundation. Financialization replaced industry. The dollar's dominance encouraged speculation over production. Wall Street became the new engine of empire, measured not in barrels or factories, but in derivatives and leverage. Money created money, until it didn't. The 2008 crisis was the moment the petrodollar turned inward. Oil demand plunged, capital evaporated, and the Federal Reserve's balance sheet ballooned. What had once been the world's stabilizer became its largest debtor. The exorbitant privilege started to look like a liability, because every new dollar printed to save the system weakened the trust that sustained it. By the 2010s, a quiet realignment began. China, now the world's top oil importer, started signing contracts in yuan. Russia diversified its reserves, shifting away from treasuries. Central banks bought gold again, as if retracing a forgotten map. The feedback loop was still functioning, but the current had changed direction. The petrodollar had given birth to half a century of growth and half a century of dependence. It built global finance and hollowed out sovereignty. It created liquidity, but extracted autonomy. The world became efficient, but not free. Every empire writes its laws in its own currency. The dollar's law was energy. And energy, as history reminds us, never stays loyal forever. If this part gave you a new lens on how power decays, tell me where you're watching from. The 21st century didn't end the petrodollar, it exposed its architecture. What once seemed eternal began to resemble software running on outdated code. still powerful but increasingly incompatible with a multipolar world. Then it happened quietly. In 2018, China launched the Shanghai Petroleum and Natural Gas Exchange, allowing oil contracts settled in yuan, convertible into gold in Hong Kong. It wasn't rebellion, it was redundancy. For the first time since 1974, a large economy could buy energy without touching the dollar. One switch, and the current shifted. Russia followed, redirecting its trade eastward. India began settling part of its oil imports in rupees. The Gulf states, cautious, pragmatic, started accepting multiple currencies. What had once been a single river of dollar flow fractured into a delta of new channels. The logic that once guaranteed control, all energy is priced in dollars, began to fade. Meanwhile, Washington's own tools turned against it. Sanctions, once a scalpel, became a habit, freezing reserves, blocking payments, cutting nations from SWIFT. Each act protected short-term policy but undermined long-term trust. The message was clear. Dollar access was conditional, and in global finance, conditional trust is fragile trust. New systems emerged. Russia's SPFS and China's CIPS mirrored SWIFT. BRICS nations discussed a joint settlement mechanism. Even blockchain-based payment networks began to surface as neutral alternatives. None of them individually could dethrone the dollar, but together they formed redundancy, and redundancy is how monopolies die. What's striking is that the pattern repeats. In the 1970s, the world tied money to energy to preserve stability. Today, it's tying money to data, to code, to digital assets. Then oil guaranteed liquidity. Now algorithms do. The names changed, the mechanism didn't. Quantitative easing replaced oil recycling. Central banks buy their own debt instead of waiting for Saudi surpluses. Liquidity flows not from wells, but from keystrokes. The energy that once powered the dollar's reign has become information, instant, synthetic, and global. Yet the paradox remains. Every new system claims independence from the old, while still being priced in the same unit. Even Bitcoin, the icon of decentralization, is quoted in dollars. The petrodollar may be dying as a mechanism, but it lives on as a language. And still the tension grows. When Washington weaponized access to its currency, it triggered a long, quiet exodus. Central banks began diversifying into gold, commodities, and regional currencies. The share of dollars in global reserves fell below 60%, the lowest in modern history. Trust is no longer default, it has to be earned. Some analysts call this de-dollarization, but that word misses the deeper truth. The world isn't rejecting the dollar, it's rejecting dependence. The petrodollar's collapse isn't the end of money's empire, it's the return of choice. And now imagine this. A future where energy trades in multiple ledgers, where contracts are settled instantly across borders, and where no nation holds the monetary veto. That's not utopia, that's software, and it's already being written. The dollar's last war isn't fought with tanks or sanctions. It's fought in code, in trade routes, and in trust. Half a century ago, one handshake between Washington and Riyadh redefined money. It turned oil into collateral and the dollar into belief. For decades, that belief was unshakable. Today, it flickers. Not because the world hates the dollar, but because the world has learned to live without permission. The petrodollar didn't collapse in a single blow. It dissolved. In code, in trade, in quiet transactions beyond the reach of headlines. No speeches, no flags, no revolutions. Just numbers moving differently. What was once the bloodstream of empire has become its echo. New currencies, digital ledgers, commodity-backed tokens, each one carries a fragment of the same promise, value without subordination. And somewhere in that transformation, the old system still hums, insisting that it remains indispensable. But history doesn't argue, it updates. The energy that once secured the dollar has become information. The trust that once flowed through banks now flows through code. and yet the essence remains the same. Whoever controls the medium controls the world. The dollar's last war was never about money. It was about belief, in whose promise counts as truth. And belief, once lost, never returns in the same form. The petrodollar didn't end. It changed state.